Hey, Jared. Nice to see you. I'm Lisa Kirschenbauer, founder and president of Omega Wealth Management, here with our Director of Investments, Jared Jones, who's also not only a CFP, but recently became a certified investment management analyst. So we wanted to talk to you a little bit about our investment management philosophy. And so why don't you take us into it? Tell us a little bit more about the approach we take. I think it's a little bit different than some firms.
Yeah, so we take a big approach into what's called goals-based investing. It kind of originated in the early 2000s, and Lisa took it on around then. So basically, we invest our clients' money in line with their goals. A lot of our clients are familiar with our Pools of Wealth document, so that really depicts it. But we want to invest your money after getting to know you a little bit better and what your goals are. Invest your money to pursue those goals and invest it for those goals in mind.
So how does that look different than sort of the normal firm where you might have an IRA account and a joint account or an individual taxable account? How does it end up being different?
Yeah, good question. So the way it ends up being different is you might have an overall investment strategy at a traditional firm where you have an IRA and a taxable account, and you might have just a range of, I would need this amount of money each year. We take a much more granular approach to it, where we have accounts set up for maybe a client has a second home goal one day. We have an account that's set up to where the client can save to that goal, and we invest it with the time horizon in mind.
So what does that end up looking like if we're keeping the timeline in mind, or the horizon in mind? How does that look different then?
So if we look at a timeline, our Pools of Wealth also shows this. We would be much more conservative with the goals coming up in the near term. Often we recommend clients have at least 6 months, at the bare minimum 6 months cash on hand for any known expenses coming up. We really like to see cash, maybe a little bit more, towards a year's worth of cash at the bank. And then in between that, maybe 2 to 5 years out, we have any goals within that range, we invest them in what's called stability focus. So not taking big dips and dives with the market when it goes up and down throughout the year, throughout the week. It's much more steady, and we can kind of predict maybe not losing as much money, not keeping pace with the market, so we're not going to make as much, but we're also not going to lose as much when it goes down. And we find that gives the clients a little bit of peace of mind, helping them step back from the headlines and the craziness of the market, knowing that they have goals that are coming up sooner, more conservatively invested.
So when we do that, how does that, you've said it a little bit, but how does that help them navigate the dips, maybe if they are taking withdrawals from their money? What does that, how does that help them?
Yeah, so if they are taking dips, if the portfolio is taking dips and they're taking money off of it, we would pull from those accounts that are conservatively invested, while also having maybe some accounts that are geared for retirement years later on. We're not going to touch them for a long time. Have those accounts invested more aggressively, so that when the market does recover, the accounts that we need, that we've been pulling money off of in the interim, have been invested conservatively. But when it does recover, those aggressively oriented accounts will recover as well.
But we didn't touch those
in the meantime.
in the meantime. Okay. Yeah. So hopefully that keeps people invested.
Exactly.
All right. So that's the idea. And so you were talking about that Pools of Wealth diagram. So how does that actually lay out, and why do you think clients really like looking at that?
I think it's a good way for our clients to see all of their accounts in one place. Often we hear from our clients, they've been thinking about their money in this way. They have different pots of money set up for different goals already in their head. So I think when they see the Pools of Wealth diagram, it really helps just solidify that. It helps us coach them. We can show them on the Pools of Wealth, hey, maybe a recession is coming up. There's been a lot of news recently that, some of the economic indicators aren't looking good. So we can, in meetings, show them, if something does go south here, we'll pull from this account. It's invested not super aggressively, and we're going to let these accounts ride out the storm more or less and recover with the market after a couple months.
Right, and as you said, I think when we tie it back into our financial life planning approach and the way we set up the goals in our planning software, that aligns real well.
Exactly.
Great.
Yeah.
So one of the other things that we do in our investment philosophy is think about active and passive investments. Maybe you can talk just briefly about what the difference is for people who don't know the difference, and how do we use these two different approaches?
Yeah, so we often joke within our firm that they're kind of like religions between active management and passive management. So if you feel passionately about one way or the other, you'll often hear that from investment professionals that they are strictly active or strictly passive. We hold them equally. We don't know which one is best, but on the active side, that's basically saying, I think I know a little bit where the market's heading. I can go out there and pick maybe the best handful of stocks or handful of mutual funds on either side of the stocks and fixed income, and I think I can beat the market. That's my goal, is to beat the S&P 500 or the Dow Jones, whatever market index you're going to follow. On the passive side, it's basically saying, I don't really know which way the market's going to head, but I don't want to get beat by the market. I'm going to follow the market exactly how it's invested and invest basically in everything that's within the index.
Okay, and so there are differences in costs as well, right?
So because a manager is going out there and doing the research involved with trying to pick companies and mutual funds that are going to beat the market, it is a little bit more expensive to invest in active management versus passive management. You're just basically buying what's in the index, so it should be a little cheaper, and oftentimes we see it as a lot cheaper.
Well, and I think our overall philosophy is that we want to have both of those styles, because although in more recent years since the financial crisis, passive investing has done quite well because the market has rallied. We think there's a place for active investing to be, right?
Yeah, so active investing, if we go back to the pools of wealth, talking about the money that's stability focused, we feel pretty strongly that that should be actively managed, because as we see accounts and strategies go through a recession like in 2008 or 2009, we saw some managers go to cash a little bit faster than maybe other places would.
Right.
The index is going to go down, and if you're passively invested, you're going to ride that index down. So we think there's some weight to be held behind being active managed on the short term.
And where do we put the passive strategies?
On the passive strategies, since there are those cost savings, we want to pass that on to the clients over the long term. So we want to be passively invested in the more aggressive long-term accounts.
Okay, and often I think we've done that in a lot of the retirement plan accounts, IRAs, SEP IRAs, things like that. There's always something going on with the markets or the political environment or whatever. How do we help our clients manage their expectations?
Really, we're trying to be in contact with them throughout any news that we think is worth them knowing. It's kind of a fine line between being too informed and not being informed enough. So we want to try and get our clients the information that we feel like they need. But we also want to help them manage the expectations on returns year to year. So as we're going through our planning analysis, we'll talk a lot about the assumption that we use for return. And in previous years, people might have expected, 8 or 10% on their investments. That's we feel those days are kind of behind us more or less. So we're looking more at 6%, or in the range of between 5 and 6.5%. So we can't really control what the market does, but we can control our expectations. And ultimately, I think people are most concerned about, will they have enough money to fund their goals in the future? They don't care as much about 20% or 10% returns. It's how's it going to impact me in my life and my goals. So we're trying to give realistic expectations to our clients, and go from there.
Well, and I think what's important to note is, first of all, we don't know what the returns are going to be going forward. Nobody does. It's a guess. And so, when you throw out numbers like 5 or 6%, even then we don't know. We have to put some input into our planning software, but really we have to continue to monitor that. Every client situation is different. Sometimes when we're talking with somebody, a prospective client, they'll ask how our portfolios do. And, I think what we always say is, every client's portfolio strategy is different because they all have different goals with different timelines, different risk tolerance. You have to mix that all together. We haven't even talked about taxes, so maybe one last thing we should talk about is where does risk tolerance, where does the tax part of investments fit in to our overall approach?
Yeah, so we're very sensitive to the tax management side of things. It's often said that it's not what you make, so you can make a 10% return, but then you get hit with all the taxes in it and you end up taking home 5%. So that's something that we think about on the taxable accounts throughout the year as clients are kind of spending down. We want to help advise them how to spend down their accounts intelligently. So we're very tax aware in the investment world. So yeah, that's
And then on the risk side,
on the risk tolerance side, we want to invest you ultimately so you don't go to cash basically
at the wrong time,
at the
right?
wrong time, because it's not going to be a loss until you take your money out. So we want to get to know you and your risk tolerance individually and as a couple both, so we can advise you on picking the right investment strategies that we think you can handle in a downturn.
Right. So to stay invested long term.
Yeah.
Right. Yeah, and I think the last thing I would say is that what's also important to us and why we want to meet with our clients at least a couple times a year is that we want to try to stay on top of what their needs are, because they do change sometimes, right? Something comes up, it's a bigger tax year, they're going to need more cash, maybe they're starting to live off the portfolio, maybe they're transitioning. We work with a lot of clients in transition who might need more cash from their portfolio from time to time. So that understanding of what their needs are, how it's changing, fits into that conversation about expectations as well.
Absolutely, yeah.
Well, Jared, thanks for spending some time with me to talk about Omega's investment philosophy.
Yeah.
Thanks for tuning in.
Thanks.